Hello, and welcome to day one of the Moss Adams Alternative Investments Virtual Conference. We are pleased that you're able to join us. We have 2 sessions today, each eligible for 1 CPE credit, totaling 2 credits for today's portion of the conference. For the National Association of State Boards of Accountancy, to qualify for these credits, you must attend each session for a minimum of 50 minutes and respond to at least 3 of the 4 polling questions in each session. Our sessions will also be followed by interactive breakout rooms. However, those do not apply towards your CPE credits. And if you meet all requirements, we will send you a copy of your certificate via email within the next 3 weeks. And now I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key.
All right, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. And now I would like to turn the floor over to Syed Rizvi, partner here at Moss Adams.
Thank you, Amy. Welcome, everyone. Thank you for joining us for our 2021 Alternative Investment Conference. I'm Syed Rizvi. I'm a partner in Moss Adams in our asset management practice, and I'll be the MC of your conference today and tomorrow. As you were designing the agenda for this year's conference, one of our main objectives this year was to not only share important industry insights and development, but also provide an interactive platform to discuss key topics most relevant to you and your firm and with other professionals in the industry. So that's why you'll see after the conference, we'll have 3 breakout sessions that will give you an opportunity to be on the camera, ask questions live, in addition to ask questions during the conference. So again, we welcome you to ask questions during the next 2 sessions using the Q&A function that you see on your bottom right. And if you're unable to respond to any of your questions, we will definitely follow up with you. We'll jot down all the questions and reach out to you individually. So our first day's agenda, starting at 10:05, we have Emmet Peppers and Matt Smith joining us. We'll be discussing what we're calling investing with a purpose, how hedge funds can generate superior returns for investors and give back to the society through charitable causes. After that, we'll have a 5-minute break, and then 11 o'clock, we'll start with a tax update. So we have 4 of our Moss Adams professionals giving you a quite comprehensive tax update for 2021. And as I said earlier, at 12 p.m., you'll have an opportunity to actually go into 3 breakout sessions. The first breakout session will be on blockchain and cryptocurrency. The second one will be on emerging funds. And the third breakout would be tax hot topics. And before we move into our first session, I do want to give a quick update on our second day. Tomorrow we'll start with our keynote panel discussion, talking about the outlook on modern finance office following the pandemic. So we have Chief Financial Officer and Chief Operating Officer from 3 funds joining us to talk about the finance office. So after that, we will have an accounting and regulatory update session. And then similar to today, we'll have 3 breakout sessions tomorrow also. The first one will be on fund structuring trends. The next one will be on current trends with PE transaction. And the third breakout will be on ESG. So without further ado, let's move on into our first session, Investing with a Purpose. And for that, I'm extremely excited to welcome Emmet Peppers, who is a founder and portfolio manager of Good Soil Investments. A quick bio on Emmet. While working in the prime brokerage business for Interactive Brokers, Emmet translated an initial personal investment of approximately $30,000 into tens of millions of dollars by taking concentrated position in companies he felt were transformational. Emmet founded Good Soil Investments on the principle that an asset management company can benefit both its investors and society. To this end, 50% of Good Soil's investment management performance fees are actually distributed among charities selected for their mission, integrity, and effectiveness. Welcome, Emmet. Also
Thanks.
Joining Emmet is Matt Smith, who is a managing partner of Good Soil Investment. Matt joined Good Soil Investment early 2021 to assist in the portfolio management and fund operations. Matt's career in finance included role in valuation and investment banking, where he gained fundamental technical skills in finance. Coupling this background with his belief in disruptive innovation, Matt achieved returns over 300x in his personal portfolio. Prior to joining Good Soil, Matt oversaw a $1 billion fleet of wind plants for an independent power producer. Welcome, Matt.
Thanks, Ed.
And thank you. And without further ado, we'll dive right into our first topic, capitalism for good. And Emmet, actually, I'll start with you. A very unique element of Good Soil Investment has been its core mission statement of capitalism for good. So can you actually elaborate what capitalism for good means within the context of your investment thesis?
Yes, sure. Thanks for having us here, by the way, and we're looking forward to have this discussion. I set up an incubator fund at the start of 2020, and during the COVID crisis, as my incubator fund was seeing, sort of exponential performance returns, and my personal trading accounts were as well, it just didn't feel as good. Like I'm profiting off of such a crisis moment in our society. There was a lot of unknowns about the coronavirus, and I had plans to start a hedge fund, and that's why I had set up the incubator fund. And I thought if I got to a certain net worth level, I'd leave my prime brokerage sales job and start my own hedge fund. But then when my net worth jumped, a few orders of magnitude in that year, it was beyond, like, I wasn't interested in just making more money for myself anymore. I had enough money that all the money I needed for myself and my family, So I had to really, think hard about what to do. And so sort of I prayed about it, and this, this notion of capitalism for good kind of crept into my head, and the name of Good Soil Investment Management came about when I was studying for a Bible study group for my church, for a virtual Bible study group during these times when everyone's locked down, and there was something called the parable of the sower, and the seed that falls in the good soil has 50 or 100 times return. And I'm thinking, that's sort of what my strategy does well, when things go right. And so that has happened to me a few times over the last 10 years, where my, as you mentioned earlier, I think my IRA account started around $2,000. It's around $50 million now in total. So it's gone up, exponentially, just that IRA account, for example. So if I do have some special skill or, to God-given skill to find, investment opportunities that other people can't find and do very well, I thought instead of just doing, benefiting my personal wealth, I should do something good with that skill. And instead of just starting a hedge fund to benefit myself and investors to make more money, I'm going to structure this hedge fund a little different, because capitalism, I do believe in capitalism strongly, but I know there's a big kind of threat of socialism kind of creeping into our society, especially amongst the younger generation. And the most capitalist thing of capitalism is like hedge fund managers in Wall Street, right? So what can I do to kind of change that perception, I was thinking. And so, I thought maybe I can set up a hedge fund and still, do what I was planning to do. But instead of just making money for myself and my investors or LPs, if it does well, we can donate half of our fees to charity. And so we wrote that in the prospectus that half of our 2 and 20 fee structure after expenses goes to charity. And we just want to be an example for altruistic capitalism within the hedge fund industry. So that's our hope and dream, is not just to make money for ourselves and our investors with our investment strategies, but to really help inspire a trend. Sort of like ESG has been a trend that's really taken off in the last 5 or 10 years. Like 10 or 15 years ago, ESG, hardly anyone talked about it or knew about it. Now it's like everywhere, and it's become like very greenwashed. And we'll talk about that later, I'm sure, in some of these other topics. But I think giving back is not a trend yet enough that needs to be there in capitalism. And that'll help change the perception of capitalism overall. So the most successful people in our capitalistic system can actually do more than just paying taxes. They can actually give back substantially, and so we wrote into our prospectus that half of our fees after expenses go to charity. And keeping on with that theme in the context of investing, as you mentioned in your question, the companies that we focus on, that we are drawn to, are companies that have what we think of as sort of like generational founders, usually. Folks that want to also do more than just make money. They have some kind of higher mission drive to their business growing to better society and better humanity, whether it's Tesla or, Roblox or, Rocket Lab or Lemonade. There's a few names that we talk about publicly that we're very concentrated in. And I think that's in common with all of them, is we look for businesses that are trying to do better for society and not just make money, although that's comes in tandem with doing better for society if they succeed.
Now Emmet, that's a very interesting point, because one of the investment objectives of good soil investment is to invest in early stage disruptive public companies. So the question is, how do you actually evaluate companies that you believe will be disruptive, right? And is it difficult to find such companies once they're publicly traded? In other words, by the time companies go public, do you think a lot of the growth in those companies is already factored into the trading multiples of the stocks when they actually go IPO? The question.
Yeah, so I can take a stab at that. So I think one of the advantages we have in being a hedge fund is a lot of discretion. So we don't have like a 10% kind of concentration limit that you'll see in a lot of ETFs, for example. So really, what it comes down to as far as idea generation is, what are Emmet and I kind of spending our time researching. So, I think what we spend a lot of time doing is just digging into a lot of, podcasts or research. And, we do a lot of kind of grounds up analysis of a lot of different things. And most of it doesn't really go anywhere. But, the things that we find interesting, we dig in more and more on and keep doing some research. And the ones that we find most compelling, we will have a very kind of large concentration in. So at any given time, we'll have, maybe 4 or 5 names that account for about 80% of the fund's assets. So, those will rotate over time. And, we've done a little bit of rotation this year, I think pretty successfully, in kind of getting out of some names where we've, like Square, for example. We really like Square as a company, and we still do believe they're kind of, disruptive and will be successful in the long term. But, when they were, well over $100 billion valuation, we thought the upside from there was limited relative to some of the other names that we're kind of constantly researching and finding more information on. So, really, I think we're just kind of professionally curious. And as far as the, other side of your question of, when they're publicly traded, is some of the growth opportunity maybe being lost out of there? It certainly is possible. I mean, we're not a venture fund, so, you won't have something probably going up like 1,000x, but we do kind of, I think, compensate for that a little bit by the use of derivatives. So we still think there are companies like Rocket Lab is a great example, where it's still relatively small at around $6 billion or so market cap. And they're targeting what we believe is going to be a very large addressable market in the future, much larger than kind of the current market that they're taking after today. And we believe that most of the market doesn't really yet recognize just how disruptive the kind of space market will be. I think it's hard for people to kind of imagine that because there's not really a great corollary for that in the past. People think of space and think it's like kind of cool, but generally companies lose money in space, and there's only so many launches per year, so there must not be that big of an opportunity. We spend a lot of time trying to look around the corner in the next 5 years, 10 years, see, okay, once you have low cost launches, what sort of services can that enable? And that's where we get really excited about the total addressable market really drastically increasing. So we think that's the kind of disruption that is available in select public equities, but it's certainly out there. But that's why we kind of like a smaller group of names that we have a high concentration, high conviction in.
Yeah, and also just to build on that briefly, the other stock I was thinking of when you were answering that, Matt, is Lemonade Insurance. That's a small insurtech play. We like that a lot because it sort of has a binary outcome. Some stocks we view as like a binary outcome, whether it was Tesla from 2013 to 2019, or now we view, Lemonade Insurance. It's like the one insurtech play that's going to disrupt insurance to some degree, or it's not. There's no in between. So right now it's like a $3 billion market cap, very small, but we think it could grow. The stock could be a 10x return in 3 to 5 years potentially. For example, none of this is investment advice, by the way. This is just our own, discussion and opinions. But we think it could be if it does succeed in disrupting the insurance industry, it could grow 10x easily. But if it doesn't, it could dwindle to become, acquired for pennies on the dollar or eventually go bankrupt. But that could take 3 to 5 years to play out, and you have to kind of put your own probabilities on the binary outcome. It's not 50-50, obviously. So we like binary outcomes as well. Anyway, sorry. There's a question, I think, a poll question.
Yeah, I think we want to jump into a poll and just gauge what the audience's viewpoint on some of this, where we stand in right now, and in terms of the, just the market environment. So I'll turn it over to Amy to read over the polling question.
All right, thank you. So our first polling question is, in your opinion, what topic will headline year 2022? A, endemic, B, climate change, C, inflation, D, cryptocurrency, or E, something else? And we will give you a few moments to respond. The polling questions are located on the slide. To respond, please click the button next to the answer you choose and hit submit. And then also, if you cannot see the submit button, please just enlarge the slide area in your console. We'll leave this up another 5 seconds or so. Okay, here are the results.
That's interesting. Inflation has been on top of everyone's mind. So I'm not surprised. Emmet, Matt, do you have any comment on the results?
I think, if this was done, 2 months ago, it would have looked very different, obviously. I think the last few weeks headlines of inflation and the transitory removal of the language by the Fed has probably, swayed a lot of people's minds or made people think differently about this. Inflation, I think that will still be a headline for time, some time. But I also think, the other things all seem to be equally weighted. So it seems, what I'd almost predict if I had to predict the outcome of that survey before you showed the results. Matt, what do you think?
Yeah, I certainly agree. I mean, I think those are all trends, and but if you put this question forward, I don't know, 2 months from now, maybe, Bitcoin goes crazy. So then cryptocurrency maybe jumps to the forefront. So I think maybe there's some recency bias here with that. But I think all of these trends are going to be important going forward, honestly.
Agreed. ESG. So speaking of disruption, speaking of social good, I think that's been on top of everyone's mind. So I think our next question, can we Emmet, Matt, goes both of you, can we discuss the role of hedge funds in particular that they can play in ESG and in all of the 3 pillars: environment, social, governance? And can you just elaborate what the role of hedge funds that they can play in ESG, and what is good soil's investment thesis and how it's built around ESG? And we alluded to some of the topics earlier, but just wanted to shed more light as to how this industry can make an impact in ESG.
Yeah, sure. So I'll take a first stab at that here. I would say I think what we're doing here at Good Soil is a lot different than the rest of the hedge fund industry. So I won't claim to speak on behalf of everyone, but I'll tell you what we believe in. First on the environment side, I think it's really clear to us for a variety of reasons that the kind of existing oil and gas industries are frankly becoming increasingly uninvestable. I was working in the energy industry before. I actually worked on a coal plant that wanted to kind of convert to a biomass, and the banks would not provide financing, even though we were trying to take coal emissions out of the picture. But they've got mandates to essentially avoid any sort of contact whatsoever with a lot of these entities. So I think that may create some short opportunities for hedge funds to bet against players in the space that I think are probably on the verge of being disrupted. We were actually just talking to one of our hedge funds peers about this recently, and they were basically taking that exact approach, kind of shorting a lot of the oil majors, and then finding a couple names on kind of the renewable side to go long. So I think kind of capital allocation and getting investment dollars out of those kind of long-term losers that frankly are bad for the environment is the right approach here. In terms of social, I think what we're doing is trying to take a stand by what we were talking about at the beginning of this session. We are legally obligated to give half of our net fees to charity. So we're really trying to tackle that kind of the worst excesses of capitalism. Which I kind of had a negative taste for hedge fund managers before I joined, honestly, but kind of seeing the vision that Emmet laid out made a lot of sense to me, and I really strongly agreed with it, that we do need to kind of change some of those perceptions. So I do think hedge funds can kind of be that source for good as long as they take it seriously, like we have done here in kind of imprinting charitable causes into our DNA at Good Soil. So it's something we really believe in, and we think it can be, our greatest good, I think, is not necessarily going to be the quantity of dollars that we donate, which we of course hope will be quite large, but I think broader than that will be also changing kind of perceptions of what others can do. We kind of hope there's a lot of hedge fund followers that take what we're doing and run with it. So that I think is our hope on where this goes. And then on governance, we try to be really transparent with a lot of things that we're doing. We have a weekly live stream that's public, open to the public. If you're interested, you can check it out on our Good Soil Investment YouTube channel. But really, we kind of open source our thoughts and our research on the current state of markets and on the current state of a lot of the companies that we're interested in. So, our LPs can watch and the general public can watch, and, we take questions and try to be incredibly transparent. So that's really important to us as well. So I think that's, my take on how hedge funds can promote it. I think ESG probably does get overused a little bit. For example, Tesla, one of our strongest conviction names, and I would argue nobody's doing more good for the environment or for the planet than Tesla, but they've got kind of a slightly above average ESG score. So I do think there's potentially some bias with the scoring methodologies, and you can spend a lot of time going through that. But I think the most important takeaway is it has to be core and it has to be real to what you're doing as a hedge fund, or it really applies to anyone. Because it's very easy to kind of greenwash ESG and do a couple small things and put out a press release, but it's much harder to really make it kind of core to who you are.
Thank you, Matt. I appreciate that analysis. Now, that's very interesting. I do want to go back to the charitable cause model that Good Soil has built into the investment structure. Maybe a question is, do you expect that model to be, at some point, and we alluded and talked about it earlier, to be more widely adopted. And it's also one of the questions that I'm seeing. One of the questions that popped up is, did that model help you, with investment fundraising in any way? So just wanted to see what your thoughts are on those two. Actually, what the if that really impacted, the model really impacted fundraising and how you added to your investment structure.
Yeah. Thanks, Syed. I think the two parts of the question. The first part, I guess, is do we expect others to follow? We don't. I mean, we have we have hopes. We have high hopes that if we can be successful with our performance as a hedge fund, it's sort of a helpful incentive for not just to make money, but to actually be an example. And the more successful we are with our performance, I think the more likely it will allow other aspiring hedge fund managers to set up a similar fee structure. If they see a successful hedge fund out and about that's donating a significant portion of their fees to charity, then they might set something up similar and say, hey, I want to be successful like Good Soil. And it doesn't have to be 50%. We're taking a strong stance, 50%, but even if it's 10 or 20%, that would be substantial in my mind and a big win if you see, a trend of hedge funds setting that up in their prospectus. And the second part of your question, has it helped? I think it has helped marginally. I think it's more like a feel-good aspect. We've had some investors that come on and just want to come on for our performance. It doesn't really seem to matter. It's the last thing they talk about or bring up. And then we have other investors that come on that the performance, that they don't really seem to care much about the performance. And they just say, hey, we love what you're doing. We want to invest, So it's a mix. So it's really nice to see that. And I think it adds like a feel-good aspect. Like when you're investing in, an ETF that doesn't have any gambling or tobacco stocks included in it, for example, people like to do that. Well, maybe, some investors, when they invest in hedge funds, now they have a hedge fund they can invest in that they know gives back to charity a substantial amount. That can feel good too, So I hope that it inspires the new trend of giving back. That's what our hopes are. And that would be the best possible outcome for us.
And on that line of thought, Emmet, well, stay on this topic. Question did come up is, how do you balance giving back from your fee structure versus compensating the officers and the managers? How do you balance that?
Yeah, so it's sort of net of expenses. So we have certain expenses we pay our third-party administrator, our accounting firm. So we pay those, expenses, and we try to keep them lean. Matt and I, for example, we don't take a salary. We have a few, contractor employees we pay sort of an hourly rate to. So we're still kind of in early stages, but, we try to keep our expenses minimal. We use Interactive Brokers as the prime broker, which is, by far known as the most cost-effective prime broker, executing broker, clearing broker, all combined in one solution. So, and that's where my expertise is anyway, working for Interactive Brokers and prime in sales for many years. So I understand their technology very well. And that helps us keep our costs low across the board, I think. So, we're very conscious of our overall costs of running the fund. And so after we, pay those expenses and fees, then whatever's left over, we cut in half with the giving to the charities and keeping for ourselves and so forth. Yeah.
Thank you, Emmet. Same line of thought, carbon offset market. So, I would say the last 3 or maybe 6 months, seeing a pretty sizable activity in this space. So, and Matt, I know you had worked in this market before. So can you comment as to what you're seeing in this carbon offset marketplace and what role hedge funds are playing? And the second part of the question is also, do you think now that we have this new, I won't say new, but definitely a growing industry segment, would that actually incentivize companies to be more carbon neutral? So just some couple of commentary.
Yeah, so given my background in managing wind farms before I joined Good Soil, I've got, I think, probably a good corollary example of what happened in the renewable energy credit market. So, if you rewind, 15 years ago, basically, wind and solar were incredibly inefficient, but at the same time, I think there was recognition that you needed some sort of incentive to start seeding this market. So a lot of states passed renewable portfolio standards, which kind of mandated a certain amount of renewable energy be produced within the states, and then that essentially created the renewable energy credit market, which became, frankly, like one of the biggest backbones toward financing wind and solar projects. And then what you saw over time is that once you had these credits, which could be rolled into the financing, so you can essentially raise debt at a lower cost of capital than kind of like incredibly risky like seed equity in some of these projects. Then over time, as more and more of those projects were developed, it drove down the capital costs. And now you're at this point in the energy markets where wind and solar like hands down beat traditional kind of fossil generation, even without credits. So I think if you look at where we are on the carbon side, it's not a perfect corollary because, like, for example, there's not really a great use for carbon. So if you're going to be putting carbon into the ground, for example, that's just like an economically losing proposition, no matter how low you get the capital costs going down. So you're going to need some sort of strong credit market in order to incentivize building these frankly really capital intensive projects. But it does seem very similar to me where you've got like there's very few of these kind of carbon sequestration projects that are active right now. The ones that do, I know there's a big one in Texas that's just losing money hand over fist. So you really do need, I think, this market to develop and mature if you're going to have some success in kind of increasing, or incentivizing these projects to be built. So that's what I would say. In terms of it being mandated versus voluntary. One of the things that I think probably surprised a lot of people is that the renewable portfolio standards that were kind of put in effect on a state-by-state basis, back in the early 2000s. It was really kind of targeted at utilities to make sure that utilities were, meeting a set amount of renewable energy. But what you saw is that a lot of companies started voluntarily buying these. So, you created this voluntary market for, companies like GM and even like BP who buy a lot of these credits, which then, essentially can be used to help finance and lower the, the hurdle rate for building new projects. So we're in the early stages still. There's a lot of work to be done, but I think like a small amount of it's kind of government intervention to at least create the pressure for these incentives. Like California already has them. There's some in Europe, and what you've seen since then is that there are these kind of derivative markets, and it's starting to be traded in a voluntary way. So I think that will only accelerate. It's not something that we played with here at Good Soil. We're only investing in publicly traded equities, but I do think that this is going to be important for kind of overall growth going forward.
Interesting. Thanks, Matt. We have a polling question. Amy, I'll turn it over to you.
All right, thank you. So our second polling question, do you expect clean energy stocks to rally the U.S. stock market in 2022? A, yes, B, no, or C, maybe. And then also as a reminder, if you would like to receive CPE credit for the first session, you will need to respond to at least 3 of the 4 polling questions that we pull out throughout this discussion. We'll leave this up a little bit longer so everyone gets their CPE. Okay, here are the results.
Interesting. Matt, Emmet, do you have any comments based on the results?
Yeah. I was right on. Look, I said I guessed it would be over A. I don't know if you see the paper. I guessed it would be A over 50%, and I was just barely right. So
we'll have to notarize that, Emmet. David. Awesome. Before we move on, actually, let's talk about Metaverse. I know that's a very new, developing topic. And most people would be aware Meta would be resonating based on what happened with Facebook. They're rebranding themselves as Meta platform, I believe. So it's gotten a lot of spotlight in the media. But Metaverse and this whole concept has been around for a while. This whole, I believe Second Life was, I'm dating myself, was kind of big in the early 2000s, mid 2000s. Emmet, Matt, do you guys want to elaborate on how is Metaverse the next, blockchain digital asset, and how can we, get into this space right now, and how are you guys evaluating it? So.
Yeah, Metaverse is like one of those words that's being used and thrown all over the place. I think there was someone measured how many times it was mentioned in quarterly earnings calls this past quarter versus last quarter. It went up like 800% or something across the board. So everyone's throwing Metaverse in their company language now, and it's hard to really define such a word like that. Like, how do you define AI? Everyone's throwing the word AI everywhere, for example. So I just think of it as like the evolution of the internet from here, and some people call it Web 3.0 or, whatnot now. But there's certain things you can say it's not, and I think it's not going to be something like in that Ready Player One book, where everyone puts on an Oculus headset to go into some virtual world together, every day. I don't think that's going to be the overall metaverse. That might be a small piece of it. Maybe Oculus and Facebook get a big enough audience and staying power where it's substantial. But I think there's going to be lots of different slices of this evolution or metaverse. And one pure play we like a lot that we've talked about for a while is Roblox. We see that as like a huge platform. It's not a game, but more of like a platform where it's attracted hundreds of thousands of developers who are incentivized to build content on the Roblox platform. And they're incentivized because there's more users. There's tens of millions of monthly or daily active users now on Roblox. And so these many millions of daily active users are spending money in the Roblox ecosystem on the different content that's built for them by the developers. And so it creates sort of a fulfilling, a feedback loop, a flywheel effect where, the better the content, the more the users, the more developers, and better the content. It's just kind of accelerating, and they've kind of reached this critical mass or event horizon where there's sort of no going back for them to succeed. There's no real competitor out there in that, nearly as big as they've gotten into sort of like escape velocity of this flywheel effect in our mind. And COVID certainly accelerated that for them. But I think people are starting to investors and the marketplace is starting to figure out that COVID, sort of catalyzed them, but it wasn't just a COVID play, that it's still accelerating from there. So we like Minecraft. I mean, not Minecraft, Roblox. Minecraft is another one, but that's not, you can't invest specifically in Minecraft. It's part of a multi-trillion-dollar market cap company, Microsoft, right? And then there's things like Fortnite, which is just privately, in the private market, it's not publicly traded. Unity Software is another one people talk about. But yeah, I mean, the metaverse, then there's like the role of NFTs and crypto and whatever this metaverse is going to be, and is it going to be interoperable, the software between the different platforms? And as you mentioned, Second Life is sort of like its own ecosystem, or similar to what Roblox is in a way, but Roblox I think is much more extensive. I don't think you can drive, I heard an analogy on a podcast I was listening to. You can't, I don't think any of these platforms want the ability for you to like drive your car from Grand Theft Auto onto the Among Us game. Like they don't want that interoperability. I mean, people talk about, hey, is the metaverse going to have this interoperability between the platforms? I don't think so. I don't think that's feasible either. I think there could be interoperability with exchanging value, through the use of cryptocurrencies, blockchain, Dogecoin being one, Bitcoin being one, US dollar, credit card transactions or whatever, So you'll exchange value between the platforms maybe in a more seamless manner in the future. But I guess that's my thoughts in a nutshell on that. I don't know, Matt, do you have anything else you want to add about the metaverse idea?
No, I think you covered it well, Emmet. I mean, it's something that I think is clearly like a hot topic right now, but I do get the sense that it's one of those overused terms that mean different things depending on who's saying it. So I think Facebook rebranding as Meta is kind of like the perfect example of like how overdone it's become a little bit. So I think there's not really a better pure play out there than Roblox. So and I do think that this is going to be a transition that's realized over the next 5-10 years plus. So I think Facebook has some great stuff like Oculus, but you can't really be a pure play on them. And there's, frankly, a lot of, negative connotations with, there's just a lack of trust, I think, with Facebook right now that it's going to be hard for them to overcome. So, yeah, it'll be interesting to watch how this evolves, but I think it's going to continue to, I think thinking of it as like kind of Web 3.0 is the right way to think about it, because a lot of stuff that's kind of on these legacy platforms right now, I think we'll transition to this new frontier, and I think that creates huge opportunities.
Mm-hmm. Yeah, speaking of new frontier, space. We saw Jeff Bezos, just took William Shatner on a flight, and it's been, then Elon Musk and everybody. So, it's here. So in terms of from your perspective right now, how, and it's an exciting industry, the whole thought of exploring the space, but how investable is space exploration, space industry, whatever you're going to call it, and what is your guys' view on this general industry?
Yeah, so it's definitely the early days right now. There's only a handful of companies that are kind of publicly traded right now. From a technology standpoint, it's very clear that SpaceX is the clear leader. Nothing can really compete with the Falcon 9 right now in terms of like cost and reusability. Some of the stuff that's being developed right now is by other companies is kind of an attempt to compete with Falcon 9 or provide similar price point to that medium launch service that they've been providing for several years now. So SpaceX is the clear number one, no matter how you judge it. But there's a lot of other players, and it's not going to be a monopoly in our mind. SpaceX is very clearly focused on kind of colonizing Mars, and that's their long-term goal. Even what they're doing right now with Starship is really, it's going to be by far the most advanced spaceship out there, and it's going to be primarily used for seeding the Mars colony. So in our eyes, that does create some opportunity for other companies who are going to be more focused on providing Earth-based services. And so that's why we really like Rocket Lab. So Rocket Lab is developing their Neutron rocket right now. In a few years, it probably will be ready to start servicing that kind of medium launch segment of the market that Falcon 9 has such a stranglehold on right now. So we think they'll be really successful, but I think there's a misunderstanding among many investors there in the industry right now about kind of what the long-term pie for this market is. I think most people kind of think of it just as getting the most launches, and so if you look at the current market, you say, all right, well, there's only so many things that are launched into Earth orbit each year. So all these companies that are trading at like 50x revenue or something like that, they just must be overvalued. And I think in some cases that's right, but I think this is where having some technical understanding of the players is really valuable. So you've got companies like Virgin Orbit, which basically only has like a space tourism operation, and I would say a very expensive one at that, and really no plans to go any broader than that. And they're trading, I think, only $1 billion less than Rocket Lab in terms of market cap. And Rocket Lab's one of our highest conviction names. They are really putting forward the technology. I think they're a clear number 2 to SpaceX in our mind. And they're developing the launch capabilities. They're developing a lot of the expertise in-house. They're vertically integrating. And they're doing that, not just to get more of the launch market, but they really they have this mission statement that they want to go to space to make life better on Earth. So the end goal that they're trying to work towards is providing services via, satellite constellations that would be a source of kind of recurring revenue down the road. So there's it's a long way, I think, to get to that outcome, and it's certainly going to be risky. I think there's going to be a lot of bumps up and down along the way. But if you add the total market cap of all these space companies right now, SpaceX is the giant with like 100 billion market cap, or is privately traded. Maybe it's about $150 billion of total market cap that's attributable to space right now. And it seems very clear to us that that's going to be much larger, say a decade from now, when you do have, constellations providing a lot of services to the United States and to the whole world, like Starlink is trying to do, like some of the stuff that Rocket Lab has been thinking about. So we think all boats are going to rise, but there's, even within that environment, there will be some, boats that significantly outperform others, and a lot of boats will sink along the way too. So it's going to be a very kind of binary outcome for most of these companies, we think. But the general tide seems very encouraging for us.
That's interesting. Emmet, do you have anything to add on space?
No, I mean, I think Matt's hit all the points. We really like the founder of Rocket Lab, Peter Beck. SpaceX trading privately, 100 billion market cap across special purpose vehicle funds, which have exorbitant fees. So if SpaceX was to go public, we would imagine that it would trade much higher than that publicly. And so for what we view as a clear second place, even if it's a somewhat distant second place at the current moment, we think it's a clear second place, only at 6 billion of a market cap. We think that's a steal. So, that's why we like Rocket Lab in particular. Interesting.
Moving on to new technology, blockchain. Well, not new anymore. Blockchain, digital assets. It's been for hedge funds in particular, it's been a hot topic. Is especially digital assets like Bitcoin. Are they really investable asset class? Are they really, as you would view a typical currency, would you view it as an asset class like a stock? So what is, Emmet, Matt, what are you guys' viewpoint on digital assets as an investable class for your fund, or you personally?
Yeah, so I'll take a quick stab at that. I first discovered Bitcoin myself personally in 2011 and bought some way back then. I still hold it. I think it was like $28 or something like that. I lost half of it on Mt. Gox when Mt. Gox went down. And, early days, it was the Wild West, especially, like the exchanges were getting hacked into. You're losing all your Bitcoin, no way to get that back. So I still have some of that, which is great. So I've been aware of Bitcoin for a long time. And I've said for a while that if there is a digital gold, I don't see how Bitcoin is not that. So I think that's the case for Bitcoin, Now for the other cryptos, Ethereum seems to have some functionality with, the NFTs or, just some extra functionality to add digital signatures to things. So, there's some others coming along, Solana or Polkadot that, could, challenge Ethereum, but Ethereum seems to be by far and away, the leader in that category. So, there's so many of these cryptocurrencies out there. I think a few will have staying power. I think it is an asset class everyone's going to want a piece of, especially as younger folks kind of grow into having control of more wealth. I think, already imprinted in the minds of 20-year-olds are, you have to have some crypto, and so as they get older and gather more wealth, they're going to attribute more of their larger wealth piles into crypto, obviously. So I think there is going to be an increase in value across the board for Bitcoin and a couple others. What Matt and I have talked about recently is, when do you get to the point where, crypto is very uncorrelated with, speculative stocks. Right now, I think it seems like when the growth stocks in the market are going up or down, crypto is going up or down, and there's just seems to be a high correlation. So when do we get to the point where, number one, crypto is not correlated whatsoever to, the high growth stocks? And number two, when do you get to the point where crypto assets are not correlated with each other, right? Right now, I think they all seem to move up in tandem or down in tandem together, like a basket, So when do we get to the point where Bitcoin's going up, but Ethereum's going down, or NFTs are going up, but Ethereum, or Bitcoin's going down, So that'll be interesting. That's going to take a while to play out, and I think that's the ultimate destination of these things. But we're still really in early days.
Interesting. Cool. I think that will lead us into our next poll. Amy, turn it back over to you.
All right, so our third polling question, when do you expect space travel to become accessible to the general public? A, 2025, B, 2030, C, 2035, D, 2040, or E, other? And we have had quite a few people ask if a recording of this session is available, and we are recording it, and we'll send it out to you via email tomorrow. All right, and here are the results.
Okay, we're not bullish on going to Mars in the next 5 years, huh? So that makes sense. Okay. Moving forward, I know we're running short on time, so I'm going to cut some of our topics, and then, we were going to talk about infrastructure, but I'll just lump infrastructure with just an economic outlook. Emmet and Matt, probably have your time. So just talking. I know infrastructure was in the news. I was like, in the summer, it was all about it. But just overall, what is your view on the market? Just we had volatility come back last week, and so if you have that crystal ball, I always ask this question: well, what are you looking at 2022 and onwards?
Yeah, I'll take a quick stab at that, then I'm sure Emmet can share his thoughts. I've been listening to a lot of different, macro experts out there, and there's a lot of different views of, inflation's going to be kind of rampant, or the Fed's going to have to raise rates. I personally think it's probably highly unlikely the Fed will raise rates in a meaningful way over a sustained period of time, just because debt service would get too out of hand. But in terms of how it impacts our, investment philosophy, it's very hard to gain an edge on kind of macro movements. So, as we think about, where broader markets are going more generally, we try to look at our handful of high conviction names and look at how they will perform in the next, 5 years or so. And so most of that performance we think is probably going to be driven by, their disruption and essentially their, kind of operational execution over the next 4 or 5 years. And even if the macro environment doesn't cooperate, we might do some things along the way to kind of hedge or to take some chips off the table, or even, increase our shorts in a few names. We're certainly open to pulling all those levers. But really for the majority of our portfolio, we think the technology advantage on a lot of these disruptive companies is going to outpace any kind of macro market, stock correction, over the next 5 or 10 years, if that does happen. So, we try to focus on where we do think that we have kind of information advantages, or just stick to the things that we think we know very well, and, kind of avoid drastic knee-jerk reactions with our portfolio based on, kind of current view on inflation or Fed kind of meeting minutes, that sort of thing.
Thank you, Matt. Emmet, any concluding thoughts?
No, I think Matt hit all the points. We should save a few minutes for Tesla. I know we wanted to talk about that a little bit. We're running out of time. You have any questions about Tesla we should go over?
I think just, what we talked about, well, what is your, number one, has Tesla priced out? Everyone, I've been hearing that for the last 5 years, right? We hit the cap. And then, here comes the Roadster, and here's the 1.9 seconds, and here's the Plaid, right? So yeah, just broadly, what do you think about Tesla? I know that's your baby.
I think Tesla, the best stocks always feel overvalued to folks that are not, they're not studying it super closely. The closer I find that closer someone studies Tesla, the more likely they are to invest in it, of course. and that includes product experience. When you use the product and, if you own the car and you drive it, most people love it. Just like when you bought your first iPhone, you probably, at first you're like, I don't know, I like my BlackBerry. Then you start using the iPhone, you're like, I love it. Even though texting is a little cumbersome with thumbs or whatever, overall, it's like a way better experience. Most people, not everyone, some people maybe still prefer their BlackBerry, but vast majority of people preferred the iPhone, and that's taken over. So I think the similar experience happens with Tesla. And you can't really quantify some of that stuff on spreadsheets very easily, and I think the financial community at large has a hard time when something's not easily quantified on a spreadsheet. And that's where a lot of our edge comes in, actually, on a lot of our investment themes. So with Tesla, we think it could be, I'm very confident it will be the largest company in the world by revenue and profits, both revenue and profits, by the end of this decade, if not, significantly sooner. But I'm also very confident that means that the stock will be the largest company in the world by market capitalization, several years before that, or a few years before that. So, right now, Apple is approaching 3 trillion, Tesla's 1 trillion. To me, that means Tesla could get, should get to 5 trillion market cap by the end of the decade, easily in my mind. Just with the growth path forward they have with their existing product suite. That doesn't even count the additional things no one's factoring in, like Tesla Bot. A lot of people laugh at that, but that's very serious. That's going to be a huge game changer. And then the full self-driving is huge, and not many folks can factor in the extra revenue from full self-driving, when that gets turned on in a massive scale. I think ARK Invest does a pretty good job trying to lay that out. But I'll leave a few minutes for Matt to talk about it too.
Yeah, I know we're out of time, so I'll try to keep this real brief. But I was a skeptic of Tesla early on, just because I couldn't get my head around the valuation. I'm very, very much a numbers guy in that regard, so I had a hard time with it. But eventually they just continued to outperform operationally, and the valuation didn't keep pace. So in 2019, it was like laughably cheap, and so I was absolutely anticipating the huge run up that kind of followed. And with where we are right now, I think Tesla has continued to surprise on just how strong their margins have been. So, I've got a very detailed financial model that, projects, earnings on a forward basis. And, if you look at their, kind of forward PE ratio or their PEG ratio, they're actually incredibly reasonable, in my mind, just kind of based on the back of their core operations. And then on top of that, so I think, while the valuation may seem crazy, if you're looking at historical metrics, if you actually do the work and can have reasonable forward metrics, the valuation is about right, maybe even a little low in my mind. Then on top of that, you have huge optionality on things like solving autonomy and the Tesla Bot, like Emmet said, and Tesla Energy, which virtually nobody gives any valuation credit for right now. So, I think there's a very safe kind of downside backstop protection just with the current execution, but with massive upside that I think will be realized as people place a higher probability on Tesla being able to execute on some of these more audacious goals that they're tackling in the pipeline.
And just one quick thing to add to that is an important notion of the iPhone comparison to product experience. People get a new iPhone a new phone every like 2 years on average, 1 to 2 years on average. People get a new car every like 4 to 6 years on average. So it takes a little bit longer to play out that product life cycle experience than it did with the Apple iPhone, which played out in 5 or 7 years before everyone recognizes the superior product. The first Teslas came out in 2013, and then the Model 3 in 2017 or 18 or whatever. So it's going to take it takes a little longer, but it's also a much more expensive device at $40,000 or $50,000 versus $1,000 or $2,000 for an iPhone.
Thank you, Emmet. Thank you, Matt. I'll squeeze in one more polling question as we wrap this up. Amy, I'll turn back over to you.
All right. So the last question for this session is, what asset class do you expect to outperform in 2022? U.S. public equities, U.S. corporate bonds, emerging market public equities, cryptocurrency, precious metals, or other?
While we're answering the question, I know there are a couple of questions in our Q&A window. We will definitely get back to you guys. I'll send those questions to both Emmet and Matt. We'll get that answered for you.
Okay, here are the results.
Interesting. We must have a younger crowd here. So with that, I know we have one more topic, but I think we covered it. I do want to wrap this up. Emmet, Matt, I really want to thank you guys for joining us. I know we had a couple of prep sessions, and so appreciate all your time and effort. Hopefully, our audience found this session to be, insightful and thought-provoking. And then we have the recordings available. But again, thank you so much for your time for joining us today.
Yeah, thanks for having us. Folks can check us out on goodsoilinvestment.com or our YouTube channel. We publish our performance publicly because we're a 506c fund. So we're open to questions. Anyone can contact us on our website and we can answer them if people have questions later for us. Thanks for having us.
Yeah, I have seen your YouTube channel. It's very interactive, so I do want to plug it in. Thank you.
Thanks.
So we have a 5-minute break. I know we're 5 minutes behind schedule, so we'll rejoin at 11:05. So please don't close your console. Amy, do you have any other administrative items?
No, just make sure to leave your console open, and then in 5 minutes, you'll hear us start back up again.
Thank you.
All right, thank you.
All right, everyone, we're going to get started again. Hope you had a good 4.5-minute break. As I say, no conference is complete without a tax update. So now I'm going to have our Moss Adams folks take us through the next 1 hour, providing a tax update. So we have Gab Khan, Lin Chen, Stu, and Britton. So I'll turn it over to you guys.
Thanks. This is Stu Myhill. Good morning, everyone. I'm a partner in the International Tax Group at Moss Adams. And today, along with Gev, Lynn, and Britton, we're going to be presenting on various tax issues. The first thing that Britton and I are going to talk about are the new Schedule K2 and K3 forms that are coming into play. So historically, flow-through entities like partnerships, S corporations, have reported out to their partners on Schedule K1, and they've prepared a Schedule K as part of their tax return. And the information that's historically been provided on those forms with respect to the international investments of the partnership or S corp has been very limited. So that's highlighted on this slide. So in Schedule K, you have line 16, which reported various foreign information. And then on the K1, that was reported on line 16 under foreign transactions. And it was very difficult at the end of the day for investors to really understand what was going on from in the foreign context, not only from a perspective of what their reporting requirements might be, but also from trying to take a foreign tax credit. A lot of the information was so jumbled together in line 16 that by the time the end user, whether that was an individual or a corporation, tried to do their foreign tax credit, a lot of the information they got from a K1 at the end of the day was largely useless. So we probably had a lot of situations where foreign tax credits weren't properly calculated. So what we've got now are new schedules K2, which is effectively an addition to the Schedule K, and also K3, which is an addition to the K1s. And the information that's going to be required on these that Britton's going to walk through quickly is substantial. As you can see by this, the old Schedule K1 was 2 pages, and now we're looking at an 18-page, I think it's actually 19-page Schedule 2, and I think the Schedule K3 is about 15 pages. So just a substantial amount of reporting. So with that, I'm going to turn it over to Britton Cunningham. Britton's a senior manager in the International Tax Group, and he's going to walk us through some parts of the schedules. Britton? Okay, seems like we're having some technical difficulties. I'm not able to hear Britton, and I'm assuming that others aren't as well. So let's just continue going through these. So the whole purpose of these schedules is to provide more clarity for shareholders and partners on how to calculate their U.S. income tax liability, particularly the foreign tax credit, and then also give them some awareness of what additional forms that they might be required to file to report various international holdings of the partnership that they're invested in. Traditionally, what's happened is we've been required to report a lot of this stuff on white paper statements. So you're probably familiar with when a tax return gets prepared for a partnership, for example. we have to attach a substantial amount of white paper to the K1s to make the partners aware of form requirements that they might have to file on their personal tax returns. So an example of some of these would be Form 926, Form 8865, potentially Form 8855, and also 8621. So the purpose of the K2 and K3 is to try and reduce that amount of white paper and have some of that stuff actually reported on the schedules K2 and K3. So just to walk through the various sections of K2 and K3, we've got Part 1, which is just general information, and then we've got Part 2, which provides information to the partner on foreign tax credit limitation calculations. And this is an area to me that's been very lacking in the past. So this will enable investors to be better able to accurately calculate their foreign tax credit. Some other information that's also related to the foreign tax credit is provided in Part 3. And then in Part 4, we've got Section 250 deduction with respect to foreign-derived intangible income, distributions from foreign corporations to the partnership in Part 5, information on guilty and Subpart F inclusions in Part 6, Part 7, information to complete Form 8621 if there's PFICs that are held by the partnership. Then also Part 8, interest in foreign corporation income under Section 960. Information about the base erosion and anti-abuse tax that we don't see a whole lot of, honestly. Character and source of income and deduction, which is very important for a partner to be able to take a foreign tax credit, how that information is sourced, if it's foreign sourced or U.S. sourced. Some limitation on foreign tax credits under 871M, and then also they have reserved a part for future use. So what does this mean to you as an operator of a fund? I'd say the first thing is just plan for a significant increase in the time that it's going to take to prepare all of this information. I would also expect that you're going to have to provide a substantial amount of additional information than you didn't in the past to your tax return preparer so that they can properly complete these forms. This could also involve, coming up with some new processes to gather that information and make sure that all the information we get or your tax return preparer gets. There's still going to be some amount of information that's going to have to be reported on white paper statements or footnote attachments. So that's one of the unfortunate parts of these new forms is they don't cover everything. So there's still some items that we're going to have to prepare white paper statements for, but they should still significantly help in the whole process.
Stu, I'm back and could take this slide if you can hear me.
Okay, great, Britton. Here's Britton. So Britton, take the next slide.
I apologize. My mic would not work. So some additional things to consider. Communication is going to be very important as far as both to us and with your partners. So you may also need to consider changes to partnership agreements or side letters to consider the additional costs it's going to take it's related to doing this reporting, or additional information you may need that's not already outlined in your ability to get that information in those agreements. Communicating with partners early around the additional information you may need to receive from them will also be important. And in general, you're going to need to consider additional information that's going to be required, that we're going to be asking you for, coming from your investments, as well as additional information around on the investor side, around the partners in your fund or partnership. Finally, uncertainty. So there is the potential that the IRS could relax these requirements. We're waiting to see if any of the letters out seeking some relief on some of these requirements may be responded to. Prepare for potential changes to these reporting requirements. Stu, anything else to add?
Yeah, so I would just say that this is a lot of work. And although I think this is going to help investors in your funds be able to report their international information, it is a lot of work. And if you go and take a look at these forms, you'll understand that it's just multiply more difficult than it used to be. I mean, they've really gone from 0 to 60 in 4 seconds here on the information that we're having to put on these forms. So just keep that in mind as far as timing and also cost of getting all of this stuff completed. So I think with that, we're ready for a polling question.
All right. So the first polling question for this session is, what information may be requested from you to meet the new K2 and K3 filing requirements? A, more information about a fund's underlying investments than has historically been requested. B, more information about partners and shareholders than has historically been requested. C, additional clarifying questions, which are likely to lengthen the timeline for annual information gathering. Or D, all of the above. And as a reminder, for CPE credit for this particular session, you will need to respond to at least 3 of the 4 polling questions that we pull up through the tax update. And it looks like most have responded, so here are the results.
Yeah, so the correct answer is D. So really all of the above. You just have to take all of that into consideration. Okay, so now I'm going to turn it over to Lynn, who is a senior manager, and she's going to walk through the SALT cap workaround and Section 1061 reporting. Lynn.
Thank you, Stu and Braden. Good morning, everyone. My name is Lin Chen, and I'm Tax Senior Manager at our Campbell office. I will go over the California SALT cap workaround and then the additional Section 1061 reporting today. I would like to start with a brief overview of the background of the SALT limitation, and then we will discuss the California AB-150 passed this year. Let me provide some relief to some California taxpayer. We will also talk about how you make the election and what's the tax impact. So the TCJA enacting in December 2017 and limited the itemized deduction for state and local taxes to $10,000 for each calendar year. The limitation applies to tax years 2018 to 2025 and create a significant tax burden for individuals that live in states with high individual income tax rates. Currently, the Build Back Better Act is proposing to raise the cap on the state and local tax deduction from $10,000 to $80,000 and extend this cap through 2030. Some states, including California, have offered pass-through entity tax as the SALT cap workaround since IRS accept the deduction of entity-level taxes on individual income tax returns. So the California AB-150 passed in July this year. It creates a elective tax that allows the taxes on pass-through income to be paid at the entity level. The owners of the partnership or S-Corp receive tax credit and can use the credit against their state income tax. This means the owners will be able to bypass the federal cap limitation if applicable. The election is available for tax years beginning on January 1st, 2021 and ending before January 1st, 2026, when the federal state tax limit is set to expire, or if the state and local tax deduction cap is repealed before the expiration, whichever comes first. Now, there are a few things you will need to know about this election. First, what types of entities are qualified to make the election. Qualified entities include partnerships, LLC with multiple members treated as a partnership, and the S corporations. They cannot be publicly traded or required to be in a combined reporting group, and they cannot have a partnership as its owner. If the entity is eligible to make the election, then you need to know who's the qualified taxpayer in the entity that can claim the tax credit. Please note that corporations are not qualified taxpayers. Qualified owners must consent to the qualified entity that making the election and pay the elective tax at the rate of 9.3% on their share of net income. Each qualified owner can separately elect to be subject to the pass-through entity tax. If one qualified owner does not want to be included in the election, the qualified entity can still elect to pay the pass-through entity tax for the others. The 9.3% tax rate is all or nothing. The entity cannot elect to pay less than 9.3%. This could be important for some taxpayers to consider if they are going to make the election. The current version of the law does not allow the utilization of the tax credit to reduce a taxpayer's liability below the California TMT. This could be a problem because the tax credits are not refundable and only have a carry-forward life of 5 years. Taxpayers thinking about making this election need to assess whether they will be able to fully utilize the credit during the years the law is in effect. Legislation is expected to clean up the language next year to specify that the credit can be used to reduce tax liability below TMT, but there's no certainty whether this update will be effective retroactively. And last but not least, the qualified net income is the total of each consenting partner's pro rata share or distributive share of income that is subject to California income tax. For qualified taxpayer that are non-residents, their share of qualified net income is their income that's sourced to California. So how do you make the election and when should you pay the elective tax? So the election is irrevocable once made and must be made on a timely filed original return. For the tax years beginning in 2021, the pass-through entity tax is due and payable on or before the due date of the qualified entity's original return before extensions. So it will be March 15, 2022 for calendar year taxpayers. However, if the entity wants to deduct the tax paid on the election for federal tax purposes, the payment must be made by December 31st, 2021. For tax years beginning on or after 1/1/2022 and before 1/1/2026, the elective tax is due and payable in 2 installments. The first installment is due by June 15 of the current tax year of the election and is the greater of $1,000 or 50% of the elective tax paid in the prior year. The second installment is due on or before the due date of the tax return without regard to any extensions. It is critical that elective tax is paid in a timely manner. If the entity did not make the initial payment by June 15, 2022, it cannot make the election for tax year 2022. I have a quick example of how the pass-through entity tax impacts the owner of the entity. So partner A and B each owns 50% of a California partnership, and the partnership generate $200,000 of ordinary income in 2021. Both A and B are individuals and consent to pay the elective tax. Since all $200,000 is subject to the 9.3% tax, the total tax due is $18,000 and $600. And they are able to make the payment by the end of December so they can deduct the tax paid on page 1. On each of the K1, there's $90,700 for line 1 income for federal and $100,000 for California. Each partner also received $9,300 of California tax credit. Assuming both partners are at 25% effective federal tax rate and the 9% effective California tax rate, each partner has $22,675 federal tax due, and they are able to utilize the $2,000 of California tax credit against their $9,000 state tax due. The remaining $7,300 tax credit will be carried over for the next 5 years, unless A or B has other income outside of the pass-through entity that can utilize the tax credit. So you can also compare if there's no pass-through entity election was made, what's the tax consequences on partners A and B versus if they make the election. So Amy, I think we have a polling question coming up.
All right, thank you, Lynn. So our second polling question for this session is, have you considered salt cap workarounds for your entities? A, yes, B, no or not applicable, or C, I'll wait and see. And while you're responding, I'd like to take this time to remind you to submit your questions for the presenters in the Q&A window. We do have quite a bit of content to cover today, so if we don't have time to respond during the conference, we will do our best to follow up with you afterwards. We'll leave this up for another 5 seconds. Okay, here's the results.
Okay, so I think 25% said yes. If you want to make the election for 2021 and want to deduct the tax payment for your entity on 2021 tax return, make sure you talk to Moss Adams or your tax advisor and make the payment by end of this month. And I'm also not surprised that many of you choose to wait and see. As I mentioned earlier, the Build Back Better Act could potentially raise the cap from $10,000 to $80,000, and the California still need to clarify if the credit can be used to reduce tax liability below TMT. So I just want to briefly go over the additional Section 1061 reporting schedule. For tax returns filed after December 31st, 2021, Section 1061 is also part of the TCJA. It recharacterizes certain net long-term capital gains of a partner that holds applicable partnership interest as the short-term capital gains. In the past, you may have already included the related 1061 information in the K1 disclosure. This is not something new, but IRS asks you to fill out a actual form worksheet A for the details and attach to the API holders K1. In addition, worksheet B, along with the 2 tables, needs to be attached to the API owner's tax return. The schedules are attached in the slides here for your reference. Now I will pass to Gav to discuss the other items.
Thanks, Lynn. So let's quickly go into our next topic, which is tax distribution clause. And the tax distribution clause is actually not only important at the fund level, but also at the portfolio company level in which the fund invests. So it's portfolio company structures LLCs. Now, the income allocated to a partner from a partnership, it can be different than the cash distribution made to the partnership. In some cases, you could have income allocated to the partner, but with no corresponding cash distribution. And what it creates some kind of a phantom income where the partner has income, but no cash to play. So the partner would have to pay the tax on the income from its own pocket. To avoid that, most partnership agreements would have a tax distribution clause, which allows the partnership to make a distribution to the partner to cover its taxes. Now, the sole purpose of the distribution is to cover the taxes, not anything more, not anything less. Now, the tax distribution can be either discretionary or it can be mandatory. If it's discretionary, you would probably see the word may in the clause, in the partnership agreement. Now, let's say the portfolio company is a startup where the partners want the cash to be inside the partnership rather than distribute and pay tax for the partners. You would probably have a discretionary clause. Or if the general partner knows that there are some losses allocated to the partner from previous years or from other sources, then the general partner may say, oh, you know what, let's keep it discretionary. But in most cases, especially at the fund level, the tax distribution clause actually says mandatory, and it will use the word shall. Now, just because it's mandatory doesn't mean that the partners would get the tax distribution. It's important to know what the definition of the available cash flow of the partnership is. So let's say if the distribution clause would say, and a distribution clause after the partnership liabilities or debt are paid, until those liabilities are paid, the partners will never get a cash distribution. So it's important that every party involved is on the same page in defining what's available for tax distribution. Now, in most cases, the tax distributions are actually an advance towards your normal distribution. So if the partner was supposed to get $10 as a normal distribution, it's part of the $10. It's not an advance. It's actually an advance towards the normal distribution, but not in addition to the normal distribution. If the partnership agreement doesn't explicitly says that, it could be deemed that this is an addition to the normal distribution, and that would actually create some kind of issue because it will change the economics of the partnership. So let's look at an example here. Let's say you have a partnership where A and B each contributed $100 of cash inside the partnership. A just gets a 10% preferred return. After that, he gets his capital, and then remaining cash is distributed to B. Let's say in the current year, the income was $40, and the tax rate at which the tax distribution will be made is, say, 40%. So the partnership needs to distribute the $16. That is 40% times the income of 40. Now, on the left side, you would see that when the tax distribution are considered as an advance, that is an advance towards normal distribution, you would see that the income allocated to A is $10 and B is $30. However, if the clause is deemed that the tax distribution is in addition to the normal distribution, it will completely change the economics of the partnership, and you would have A getting $17 and B getting $23. So it's actually beneficial, it's actually recommended to make sure it's explicitly stated in the tax distribution clause. Now, there are some other consideration to consider in terms of the tax distribution clause. So one is, how do you define profits versus taxable income? We recommend that the tax distribution clause should be based on taxable income. We have seen some partnership agreements where it says profits. Now, if it's profits, the partnership agreement should define what profits are, because profits could be book income. And there could be instances where you have book income but no tax income, and the partnership would have to make a tax distribution to the partners, even though there is no tax income. Cumulative versus annual income. This is also an important thing to consider, because let's say a partnership had losses in the previous years and had income in the current year. Now, the partners did get benefit for the losses in the previous years, right? So should the tax distribution be based on cumulative income, or should it be based on current year income? That can also change the economics significantly. Character of the income. If in most cases, the fund generates capital gain, should the tax distribution be based on long-term capital gain? Should it be based on short-term capital gain? Because long-term and short-term have different tax rates. So these are some of the considerations, some of the things that you should be look out when you draft the tax distribution clause. With that, let's go to the next section. Let's look at the partnership audit consideration. But before that, I think we have a polling question. There you go.
Yes, we do. So the third polling question for this session is, have you received a notice of administrative proceeding that initiates a partnership audit? A, yes, B, no, or C, not applicable. And while you're answering, for those that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. And we'll also be sending them via email tomorrow, along with a recording of this conference. It looks like everyone's pretty quick on this one, so here are the results.
Yeah, I'm not surprised that a lot of us have actually not received notice. But let's quickly go to the next slide. So the IRS realizes that the partnership is the least audited entity of all the other entities, whether it's corporation, trust, individuals. Partnership is the least audited. And the simple reason for it, partnerships are complex. But the IRS wants to change that. It recently initiated a program called Large Partnership Compliance Program. And the goal is to create these algorithms, and these algorithms will make the IRS or help the IRS select audit candidates in the partnership space. With that, let's look at some of the rules related to the new audit regime. Now, when I say new, it's actually not really new. It's been created by the Bipartisan Budget Act of 2015. So it's been there for some time. But like we saw the polling question, at least not some of my clients have got any notices under the new BBA rules, or under the new audit rules. But that could change, right? That could change because the IRS is now creating all these programs, including the Large Partnership Compliance Program. And what's the uniqueness about these new audit rules is that the partnership is responsible for any underpayment of tax, including any interest and penalties. So the IRS doesn't have to go after the partners. The partnership is responsible to pay the tax. Now, there is an option for the partnership to make an election where the partnership can push out those adjustments coming from an audit to the partners. And let's look at those. Let's look at the push out election. Now, like I said, the general rule is that the partnership is responsible for any underpayment from an audit. But the partnership may elect to make a push-out election where it pushes out the adjustments to its partners. The partners will pick up the adjustment in the adjustment year. So let's say the partnership is getting audited for 2018 by the IRS. 2018 is the reviewed year, but if the audit happens in 2022, 2022 is the adjustment year, and that's when the adjustments are picked up by the partners. Now, on the surface, the push-out election actually looks pretty good because the partnership is not responsible to pay the tax. You have the partners paying the tax and the interest and penalties. But the push-out election does have its drawbacks. So let's say the partnership got audited and the resulting audit, it resulted in a positive adjustment. When I say positive, it essentially means unfavorable adjustment. The partnership decides to make the push-out election, pushes out all the adjustment to its partners. The partners pay tax in the adjustment year. But let's say the IRS audits a partnership and the result is a negative adjustment. When I say negative, it means unfavorable adjustment. What it essentially means is that the partners overreported income and overpaid tax in the previous years. That amount or that adjustment or that overpayment of tax can now be used as a credit in the adjustment year. That is the year in which the audit takes place. However, if that credit is more than the tax of the partner, then any excess amount is actually not carried forward, neither is refunded to the partner. Let's look at an example here. Let's say a partnership had recognized $100 million of capital gain in 2018. There are two partners in the partnership, partner A and partner B, each owning 50% interest in the partnership. Now, for some reason, the partnership allocated $100 million to the partner A and zero to partner B. The partnership got audited in 2022 and quickly realized that, hey, $50 million should have been allocated to B, and B did not get any $50 million allocation, so B is underpaid his taxes by $10 million. So when I say $10 million, I'm assuming a tax rate of 20%. Now, since B did not pay $10 million tax in 2018, B would pay the tax in 2022, that is the year in which the audit happened. But A actually overpaid tax by $10 million, right? So A would have a $10 million credit to offset its tax liability in the adjustment year in 2022. But let's say A's liability is only $6 million. It can take the credit, offset the remaining $6 million, but there's still $4 million of credit. Unfortunately, that credit cannot be carried forward. It cannot be refunded by A. A essentially loses the $4 million of overpayment of taxes. So that's one of the drawbacks about the push-out election. Now let's look at some of the general rules under this new audit regime. So like I said, if the partnership gets audited and any adjustment is paid by the partnership, provided it doesn't make the push-out election. Now, if it's a positive adjustment, once again, positive means unfavorable, the partnership makes the payment on the underpayment along with the interest and penalties in the adjustment year. But what happens if the partnership, if after audit, there is a negative adjustment? In that case, when I say negative, it means favorable. So essentially, let's say, the partnership probably over-reported capital gain of $5 million in previous years. That means now what the partnership can do, provided there is no push-out election, it can reduce its income in the adjustment year by the $5 million of capital gain. So if it has, say, $6 million of capital gain, it can take the $5 million that it over-reported in the previous years, reduce the $6 million, and now it picks up only $1 million of capital gain. So there's a true-up mechanism when there is a favorable adjustment resulting from an audit. Now, in most cases, if the audit results into a positive adjustment, once again, positive means unfavorable, and a negative adjustment, that means favorable, the IRS would not allow the partnership to net the adjustments unless the adjustments are related to the same character of the income and to the same transaction in the same year. So let's look at an example here. Let's say partnership A omitted $5 million of capital gain from the sale of stock X with a holding period of 3 years, but also over-reported $5 million of gain from the sale of stock Y with a holding period of 4 years. Now, both these adjustments, let's assume, happen in 2018. Both are related to long-term capital gain. In that case, the IRS would allow the partnership to net the two adjustments together, and that net adjustment is essentially zero. Now, if the partnership gets audited and it results into an adjustment, whether it's a positive adjustment or a negative adjustment, it should impact the outside basis of a partner. Okay, so let's look at an example here. Let's say partners A's share of income from partnership X was $10 of capital gain in 2018. Again, for some reason, the partnership did not allocate that $10 in 2018. In 2019, partner A sold its partnership interest to partner B. The partnership got audited in 2021 and quickly realized that there is under-allocation of income to partner A. Partnership does not make the push-out election and pays tax on the $10 of capital gain. So assuming it's 20% tax rate, it pays $2 of taxes. Now, since the partnership paid tax on the capital gain, it should get some benefit, right? It should get some benefit in terms of the partners increases their outside basis. Who gets the increase in outside basis? Is it partner A? Partner A is no longer in the partnership. It has to be partner B because partner B is in the partnership when the partnership got audited. I think this is an important topic for a lot of us. So if the partnership wants to change a previously filed return, and if the partnership falls under the new BBA rules, that is the new audit rules, it can no longer amend the partnership return. It can only go through an AR process, which is essentially called Administrative Adjustment Request. And based on the current guidance, the AR process seems pretty tedious and includes a lot of forms to be filed to change a previously filed return. We haven't listed all the forms here, but essentially there is Form 8082, and along with that, there is you may have to file a Form 1065 or 1065X, depending whether you want to electronically file the AR process or you want to paper file it. But the bottom line is that it is a tedious process. And any adjustment from changing a previously filed return is picked up by the partner in the adjustment year. Similar to audit, adjustment year is the year in which the partnership changes a previously filed return. Now let's say the partnership realizes that it needs to change a previously filed return, and the partnership does its calculation, and the adjustment is a positive adjustment. When I say positive, it means unfavorable. The partnership can have two options, essentially. It can pay the tax on the positive adjustment along with the interest and penalties, or it can make a push-out election similar to in the case of an audit, where it will push out all the adjustments to the partners. This can be also a tedious process because now you have to file a form which includes the adjustments and provides those adjustments to the partners. But let's say the partnership realizes that it needs to change a previously filed return and realizes that, oh, the adjustment is actually negative adjustment, that is a favorable adjustment. In that case, the partnership has no option but to push out the adjustments to its partners. So this is different than in the case of an audit where there was a true-up mechanism. In case of changing a previously filed return, you would have to push out all the adjustments to the partners. Now, the AAR must be filed. That means you can change the previously filed return within 3 years, the later of the date the partnership return was filed, or the last day for filing the return excluding extensions. This is very similar to the rules regarding amending a return, right? You cannot amend the return after the statute of limitation passes. The statute of limitation for federal is 3 years. So you cannot go through an AR process after 3 years. Now, if you receive a notice from the IRS regarding an audit, let's say for 2018, the partnership can now no longer go through the AR process, right? It now has to wait till the IRS comes out with the result on the audit. So like I mentioned before, changing a previously filed return is a complicated process now, includes a lot of forms, and just go through the AR process seems very complicated. So what can we do? Now, we cannot completely avoid it, but what we can do is we recommend that we all extend our partnership returns. If you extend the partnership returns, you have September 15 to file the partnership return, right? So let's say even if the K1s are due in, say, February to investors or March in March to investors, you can still extend the return and file the return in April if you want to. If you file the return in April, you have from April to September 15 to make any changes in the return without going through an AR process. All you're going to do is file a superseded return. Now, a superseded return is way more easier than going through an AR process. It's simply replacing a previously filed return with the IRS. But if you want to change a 2018 or 19 return, or even 20 return, you really have no option but go through the AR process. Now, there's some good news, is that the partnership can actually completely elect out of the new BBA rules or the new audit rules. However, the partnership needs to have less than 100 partners, which is, I think it's quite achievable. In most cases, it might be less than 100 partners. However, the second requirement is that all partners needs to be eligible partners. What it simply means that if you have a partnership partner in your partnership or fund, you fall into the BBA rules, you cannot elect out of the BBA rules. So if it's a family partnership where you just have individuals, you probably should think about electing out the new BBA rules. Now, there are some advantages about the new audit rules. The obvious advantage is you have this partnership paying the tax on any underpayment. So if the partnership or one centralized entity paying the tax on any positive adjustment or underreporting of tax along with the interest and penalties, it's a lot easier for the IRS to audit. Now, if it's easier or the process is simpler, then the IRS can come out with the results from the audit much quicker. But there are some obvious disadvantages. The disadvantages is right now is that not a lot of clients have actually got the notice. So if somebody actually gets a notice, then there is no reference to look at some other taxpayer on how they have dealt with the notice. So that's the biggest issue. The other issue is that since the partnership is responsible to pay the tax under the general rule, that tax rate is the highest individual tax rate. Now, if that adjustment is related to a tax-exempt partner or any partner where the tax rates are much lower, there's some leakage of taxes. The IRS did provide some guidance as to, you can modify the adjustment, but it's still there's some chances of tax leakage there. The BBA rules also introduced this concept of partnership representative. And the partnership representative has these powers to make decisions. But unlike in the previous rules, where they have the concept of something called tax matters partners, partnership representative doesn't need to be a partner in the partnership. If the partnership representative is not a partner in the partnership, there could be some conflicts between the partnership representative and the partners. That's another disadvantage. Now, let's say if the partnership gets audited for 2018. 2018 is a reviewed year, and it gets audited by the IRS in 2022. 2022 is called the adjustment year. Now, the partners in 2018 may not be the partners in 2022. There could be some partners leaving the partnership. That can also create some issues, especially in case of a hedge fund where where investors come in and out, or any open-ended fund. With that, I think we have a polling question.
All right, so the last polling question for today's conference is, what course of action do you think would be best to deal with partnership audit adjustments? A, rely on the default rule and let partnership pay. B, make the push-out election. C, consult with your tax advisor before making a decision. And also, I do want to make you aware of a survey that we have set up where you can provide feedback for today's session. You can find it linked in the slide deck and handouts window in your console. And any feedback you provide is greatly appreciated. Leave this up for a few more seconds here. Okay, here are the results.
Yeah, that's a great result. Yeah, you want to ask your tax advisor before you make the push-out election or have the partnership pay. Because push-out election on the surface, like I said, looks pretty good until the audit results in a negative adjustment or favorable adjustment. Then you could have a problem where you could create a credit which may be more than the tax in that particular year, and some of the partners may miss out on the credit. So with that, I think we can go to the very last topic of our session, legislative updates. So we're going to talk about some of the bullet points here. The biggest thing is the Obama administration came out with this rules regarding the qualified small business stock. So under Section 1202, the gain on a sale of a qualified small business stock is either excludable up to 100%, 75%, or 50%, depending on when the fund or when the taxpayer bought the qualified small business stock. The Biden administration proposal is to eliminate the 75% and the 100% exclusion for any taxpayers with an AGI of more than 400,000. It'll leave the 50% exclusion, but this is a substantial change, and it's going to impact a lot of our clients, especially in funds that are investing in qualified small business stock, where the 75% and the 100% exclusion is completely wiped out. Now, this impacts, obviously, if it becomes law. So right now, it's just a proposal, but the chances are that it could become law. A lot of the funds have actually structured their management companies as a limited partnership. And the reason they did that rather than an LLC is because the fund managers could come in the management company as a limited partner. And there is a position that the limited partners in a limited partnership are not subject to self-employment tax. And since the management fees are considered trade or business, the taxpayer may be not subject to even the net investment income tax. However, the Biden administration proposal is to levy net investment income tax even on business income that has not been levied any self-employment tax. So that planning structure can be jeopardized if this becomes law. There are other significant proposals out there. One is the excess business losses carry forward. So this is more applicable if you receive a bunch of losses from an operating partnership, or if you're receiving some losses from any business losses. So with the Trump administration, the business losses were limited up to a threshold amount. I believe the threshold amount for 2021 was around $524,000 for taxpayers who are married and filing joint, and half of that for taxpayers who are single of filing separate returns. Now, these disallowed business losses became part of a net operating losses. So what happened was these losses were effectively deferred only for a year. The Biden administration wants to change that and wants to have these disallowed excess business losses not to become NOL, but remain as excess business losses. Again, if this comes into law, it can defer the taxpayer's ability to take these losses, and hence the deferral could be more than a year. It could, it just depends on how many losses you get, but it could be deferred for sure more than a year. But again, it all depends if it becomes law. One of the other emphasis by the Biden administration is to make sure the IRS is funded. And the reason is to make sure there are audits done, especially in the partnership space, where it has been the least audited entity among all the other entities. I think there are other proposals too, but I think these are the ones which are quite important. And I think with that, we might be at the end of our session. Yep. Amy, yeah. I'll send it over to you.
Thank you, Gav. Appreciate the detailed insights. Thank you, Lynn, Stu, Britton. I think this was an excellent update for the year, tax update. With that, our general session for today has come to an end. And we will follow that by our 3 breakout sessions. So I'll be logging off soon because I'll be leading one of the breakouts. But for CPE eligibility, I think our session has ended. But before I leave and hand it over to Amy, just a quick reminder on our day 2 tomorrow, same start time. Again, just a reminder, our first keynote panel discussion will feature Promit, Yuan, and Alex. We'll be talking about the finance office and the functions. Then we'll have followed by an accounting and regulatory updates. And it will also end noon Pacific Standard Time. We'll have 3 breakouts similar to today's session. So with that, I'll be logging off, and I'll be heading over to Amy, who will talk about the logistics of how you can join one of the 3 breakouts. Amy?
All right, thank you, Syed. As Syed mentioned, this is the end of our general session for day 1 of our virtual alternative investment conference. However, we do have some breakout rooms set up for our attendees. If you would like to join us for a discussion, please select one of the 3 rooms listed on the right-hand side of your console and click Join. You will have the option to use your webcam and microphone to make this an interactive experience. Please note that there is a maximum of 50 attendees in each breakout room. So if the room is full, you may need to just select another session. And also, as a reminder, CPE is unavailable for our breakout sessions. So thank you, everyone, for joining us, and we hope we'll see you in one of our rooms. Take care.